This is Scott Becker with the Becker Private Equity and Business Podcast. We come to you regularly with short business episodes, short private equity episodes. We also are joined regularly by brilliant business and private equity leaders. Then periodically we have body of life episodes. Today's episode's a special treat. We had a chance last year to visit with Scott Colbert. Scott is the chief economist at Commerce Bank, absolutely brilliant, and gave us last year probably a better sense of highlights, things to think about in the economy than almost anybody had a chance to talk to in a long time. Scott, without further ado, can you take a second to introduce yourself and tell us about Commerce Bank, and then we'll talk about sort of economic forecasts and some of the things you're seeing and expecting.
Thank you for having me. I appreciate it. I work for Commerce Bank, which is a Midwest regional bank, about the 40th biggest bank in the country, about the second highest credited rated banks, tied with a JP Morgan and a number of others in the country. So pretty high quality Midwestern based bank. Within the bank, we have a trust department, Commerce Trust. That's where I spend most of my time. And we're a money management arm of the bank, and we manage about $60 billion, maybe even more now for other people. My group, the bond group, the fixed income group, is directly responsible for about $28 billion of other people's money, primarily mutual funds and institutional large separate accounts.
Thank you very, very much. And take a moment on sort of forecasting for this year, the economic forecast, what trends you're watching, what are you seeing? Tell us what you're watching.
Well, there's no doubt the economy is cooling a little bit, but it's certainly not falling off the cliff. And of course, it's performed much better than almost everybody expected post-pandemic. The big reason, though, of course, that it performed so very, very well is, the tremendous amount of stimulus that was provided, not only in the form of monetary policy, 0% interest rates and quantitative easing, but mostly fiscal policy, right? Large deficit spending that was basically helicopter money, if you will, coming at the population, both from the business point of view and from a personal point of view. And that, propelled economic growth. Now, there's no doubt things are slowing and cooling, but this is a country that doesn't have a recession unless net we're losing jobs. And we've still created on average a little over 200,000 jobs per month so far this year. And to the extent that we're growing jobs, we're going to have a growing economy. And whether or not we've had a soft landing or not, there hasn't even been even close to a landing. So we haven't landed. We've slowed, but there's been no landing whatsoever. And the good news, the best news now, is because inflation has rolled over as much as it has, the Federal Reserve now has some ammunition in its pocket to deliver back some help to the extent that the economy is slowing even more rapidly than most expect.
And Scott, let me ask you this question. The federal deficit was $1.7 trillion or $1.7 trillion for 2023. The national debt's currently above $34 trillion. Not only how sustainable is that, but how much of that debt and deficit spending is what's avoiding a recession, and it feels almost like we're artificially avoiding a recession. Again, my words, not yours.
Yeah.
By sort of deficit spending so much and injecting so much cash into the economy. How sustainable is the U.S. debt situation? And at what point do people say, yeah, we're getting inflation down, but we've had to raise rates so high to do it? Because inflation's built in when you have this much of a deficit. And if you're having 1% to 2% growth, deficit spending of 7% or 9%, it seems like we're losing that game. I mean, I see or so of our economy, yet growth of only 1% to 2%. How do those numbers square up, and how sustainable is that?
Well, it's the biggest chink in our economic armor. And of course, the U.S. has been outperforming almost everybody on the planet. But a big driver behind the scenes of that outperformance has been government deficit spending, or effectively borrowing some of our prosperity forward, right? It's hard to get your arms around, how to approach this, but I think it's pretty simple. When you look at the total economy, we're about a $28 trillion economy now. Now, that's not inflation adjusted. That's just the nominal growth from a 22 trillion economy pre-pandemic. About 2/3 of that growth is inflation and about 1/3 of it's real, but now we're about a 28 plus, working on, we'll be a $29 trillion plus economy starting next year. Of that, we collect government revenues that are about 17.5%. we spend a little bit over 23 to 24%. And that deficit, that 5 to 6% deficit, is what you're talking about. And by the way, that 5 to 6% deficit that we're having right now in 2024, that is the low tick for the last essentially 4 years post the pandemic. So the good news is the deficit's coming down as a percent of GDP. The bad news is it was at its peak over 14% during the pandemic. It's been coming down and down, but that deficit spending, that cumulative deficit spending, has accounted for a little over 8% of every dollar spent since the pandemic started. So in other words, we're spending 92 cents of our own money and borrowing 8% forward. So that's the way I like to think about it. And of course, the government debt as a percent of GDP in private hands is about 1 times GDP, almost exactly 1 times GDP. So that's that $29 trillion you hear about. And then when you add the Federal Reserve's balance sheet in, the other $5 trillion of debt that the Federal Reserve bought up, that's where you get this $34 trillion highest debt to GDP level ever. Now, you asked, is it sustainable? It is very sustainable at a low interest rate level. For example, aggregate debt in the country, when you include the 4 big piles of debt, and what are they? Government debt, personal debt, that's your credit cards, your auto loans, your mortgages, your student loans, all that stuff. Corporate debt, that's all that corporate bond and private credit that you hear about, and bank and financial debt. When you add that up in aggregate, that's about 3.3 times GDP, which is just about what it was prior to the pandemic. So aggregate debt as a percent of the economy hasn't changed much. The composition of it has. The big borrower has been the federal government. That's what has to change. That direction has to, basically at today's interest rates, it's in an unsustainable level, and they need to bring the deficit. When I say they, it's hard to say who they is, but the government needs to bring the deficit down. And you'd like to see it with a combination of both things, probably, some modest increase in revenue and some modest decrease in spending. But it's very difficult to do because so much of government spending is simply the entitlement programs. It's a tough word to use, but let's just call it mandatory spending. With Social Security, $1.4 trillion, and all of the Medicare and Medicaid and insurance plans, 1.6. Over nearly 50% of the government's budget are just the entitlement programs. The total government budget is about $6.3 trillion this year, growing to 6.4, 6.5 next year.
I mean, it's simply amazing that we've got an annual budget of 6.6, 6.3, 6.4, and we bring in 4 to 4.5. Those are just not sustainable numbers, at least from my perspective. Talk to us a little bit about 2 other issues. Where are the opportunities in the bond environment and also AI? We talk so much about AI and its impact on the big tech stocks and the Magnificent Seven and so forth. But what do you see there in terms of AI in the bond market? Any thoughts there, Scott?
Well, in terms of the bond market, where we're putting monies to work, the high yield market's been has been on fire. So it's really, credit spreads are fairly tight. We've overweighted the corporate sector, which was a good thing to do because, during the pandemic, they thought even, normal places could possibly bite the dust. And of course they didn't. It was a very quick recession, a 2-month recession, and corporate credit spreads have been improving. They're not at all-time tights today. In other words, the average incremental cost to borrow money is not at the tightest levels it ever was. That was back 1997, but they are within 20 basis points, if you will, of the average corporate bond, being as tight as it's ever been to a treasury bond. So, credit spreads are tight. One place that's underperformed has been just the good old-fashioned mortgage market, because as interest rates moved up, all those mortgages did what? Well, they stopped paying. They extended an average maturity. Nobody moved. And so those bonds have become pretty cheap. So that's one sector to pay attention to, take a look at. Another place has been basically bank and financial preferred stocks. That's been a fairly inexpensive area because people were worried about the banks, particularly the commercial real estate problems. But the banks are working through this swimmingly. The stress tests just kind of prove how much better shape the banks and financial system are in today compared to where they were during the financial/subprime crisis. So that's a place to look. But the biggest place to look for value is simply out the curve, where you can lock in higher yields today, I think, than you're going to have the opportunity to, in the not too distant future, because honest to God, the Fed will be lowering rates. They have the ability to lower rates. The inflation is moving in the right direction. It's already ahead of the Fed. And in fact, now the Fed may be getting just a little bit behind the quick rollover in inflation. With regards to
this is a great
Oh, go ahead,
Let
please.
me talk about that for 1 second, because this is a
Yeah,
great question for investors.
yeah,
So much of us have loved, if you're a saver
yeah.
and a treasury bond investor,
Hmm.
we've loved these 5% rates,
Yes.
but seemingly those are going away over the next year, and we'll be back down to 4% within a year. And you hear more advisors saying, time to start locking in some of these 4.3% rates that are 10-year rates, which we haven't seen much at all in my generation, quite frankly. I'm 60, not to say it out loud, but we haven't seen a lot of it over the course of the last 20, 30 years. So you look at the 10-year at 4.3%, and it seems pretty enticing, but we've been really excited by these juiced 5% returns. Even though after inflation, it's a great question as to how you're doing, but fascinating, because I hear your advice that I've been hearing more and more. Lock in some of those longer term treasuries too, or bonds, whatever you're doing. Look out on the yield curve some. That's fascinating. So talks about AI now, Scott. AI now, Scott. Thank you.
You know, AI is part of what I consider to be just this ongoing progression of productivity in society. It started forever ago, but the steam engine and electricity, the supercomputers, and then the personal computer, the internet. It just kind of moves from one thing to another, which affords companies in America, especially because we're fairly productive about basically growing our revenues faster than we grow our costs, to do more with the same amount of inputs. So we're doing more every year with about the same amount of input via technology and productivity. Is AI the be all and end all to the world? They thought the internet was, certainly, and the internet certainly changed things, but it took a while for all that to play out. They thought the personal computer was going to be, the big change. It took me a good decade to figure out how to make my PC hum at all, and then even then some. I'm still not great with it. And I own the first IBM AT. I remember I bought it for $1,000 in 1980. So and it didn't do a thing because they hadn't invented software yet for the gosh darn thing. So it took a while for that to take place. I think it's going to be the same way with AI. It's going to take us a while to figure out, what the value is. We're trying to, use it everywhere we possibly can. But I will tell you, near term, I haven't been able to make an economic forecast using it. I haven't been able to write any papers using it. Kind of what comes back is generic stuff that by the time you put the inputs in, you've written the paper for it in the first place. So I think it's a gradual, slower thing. Now, are the valuations in the equity market justifiable? You got to talk to those growth equity managers, and I'm a value person, and so thank God they invented the S&P 500 index, because I wouldn't have had the guts to buy any of these companies that have soared in value like they have. Thank goodness that I have an index fund that blindly owns some of those companies and pulls me ahead.
No, it's exactly right, isn't it? I mean, most of us at the end of the day of a certain generation have become more index investors than we're individual stock investors. So much knowledge out there about how difficult it is to beat the market, and how much more volatility if you're trying to be an individual stock picker. Fascinating. Scott, anything else that's top of mind for you that you're thinking about? And also, what are you most focused and excited about?
Well, one of the nice things that's happened, and a lot of people have been writing about this. We put this in our mid-year outlook that we expected the markets to broaden out, um, and I mean almost as if on cue, when the markets finally believed that the Fed was going to be able to cut rates in September based upon the last CPI readings, that was the day that the market suddenly began to broaden out, and everybody suggested that these lower value, the lower capitalized stocks, the value oriented stocks, more cyclically sensitive stocks that are interest rate sensitive would improve, and they have materially. The S&P 500 is actually down 1 or 2%, and the Russell 2000 is now up 9%. It's still down 8% on a relative basis for the year, but we're finally seeing some of this broadening out in the market. So I think that's number one for an investor. Probably the biggest opportunity is to look around and say what hasn't worked very well, and maybe take a little of those gains in that S&P 500 mega cap universe and spread some of them around. Secondly, I think we're still more optimistic than the average person about the economic expansion. And look, if the average economic expansion post 1980 has been a little over 9 years, we are 4 years and maybe a month into this economic expansion. So there's no real reason that this thing has to just suddenly die on its own, or suddenly, fade out. And if we have another 3, 4, 5, 6 years of economic expansion, the equity market's going to do just fine. And, the valuation levels probably don't justify the biggest capitalized, PEs, if you will, but certainly the broader market is a better value. And timing the stock market is a fool's errand anyhow, because if in fact we have 3 or 4 or 5 years still to go, you're going to want to own stocks. You're going to stay in this market, and getting in and out. I don't care much for Jim Cramer, but I do like, his take on some of these big stocks. You can't trade them. You just own them and you let them, and you just run with them. So I think our optimistic outlook, being a bank here in the Midwest, we are very in tune with, we're kind of the largest bank if you define the geographic region, someplace between Denver and Cincinnati and south of Chicago and north of Dallas. And, we have thousands and thousands of customers out there. And yes, things are cooling a little bit, but in general, businesses are in awfully good shape. Their margins are in good shape. Their profits are still growing. And if you're growing your profits, you're going to continue to add to employment. And when I talk to groups of people, and sometimes it's 3, 4, 500 people in a group, I'll ask who's still hiring, and almost universally the hands go up. They're not hiring as aggressively or assertively as they have to. They've caught up a lot, but in general, there's still a need for labor. And again, this country continues to grow if we add jobs on a year-over-year basis.
Scott, as always, I want to thank you for joining us today on the Becker Private Equity and Business Podcast. It's always great to visit with you. I always learn more from talking to you than I do from almost anybody else about what's going on and how to look at the economy and straight talk. Thank you so much for joining us today on the Becker Private Equity and Business Podcast.
Well, thank you for having me. Delight to talk to you. Hope to talk to you again near future.